Hi, hello. Welcome to today's live webinar. I'm Navatar's Nick Donato. What we prepared for you today here is a roundtable discussion on what every private fund manager should know about working with placement agents, both before and after the contract papers are signed. To do that, we've gathered 4 veteran placement specialists who have worked on a wide range of fundraisers in terms of size, strategy, and the geographies that they've targeted on behalf of fund managers. I will co-moderate the conversation, but for help, I've asked to join us an Investor Relations Director who I know can provide us the in-house perspective on all of this. Very shortly, I'll have all 5 of these panelists introduce themselves. They are waiting in the wings here. But first, let me breeze past some housekeeping here. You can submit any questions that you may have as we're going through our conversation here using that GoToWidget tool on your screen. Also, a recording of the webinar will be made available to everyone after our broadcast. And now for the roundtable here, I want to set out some quick goals for what I hope to get from the conversation today. First, we want to provide some ways for GPs to test your stated claims, and that includes your performance claims, your claims of having access to the LP community. Secondly, let's hear some ways that a GP can know that they'll be made a priority as you're juggling multiple fundraisers, or better yet, how does a GP know that the two, you and the GP have similar working styles and so you're a cultural fit with each other? Let's also hear some ways for the manager to test placement agents on what LPs want in light of current market conditions, so things like where fund terms are moving, or what issues do LPs see as deal breakers today. The last few things are to get some understanding on how price negotiations look today. So, for example, do most agents now charge the same amount of money for re-ups as they would if they're bringing on an entirely new investor, which would historically require more work, but that's becoming less so the case today. And then, pending time, let's hear the roundtable's views on best practices for things like monitoring compliance or making life easier by using time-saving technologies. I can tell you that the 4 placement agents with us today all use Navatar. So, with the agenda set, let me quickly explain to you, too, why this roundtable was put together in the first place. Last year, half of all private equity funds used a placement agent. That data comes from Preqin. It's an industry data provider. And the reason that that's notable is that even though it's roughly in line with what happened in 2014, we've been hearing for a few years now that GPs would begin to use less placement agents during fundraisings. And that's not been the case. That's not happened. And then you've got the fact that fundraising continues to be this marathon exercise. So funds that held a final close in 2017 spent an average of 17 months on the road, which is pretty much in line with 2014 again, but it also shows that LPs continue to be picky. In 2006, for comparison, so before the crash, the average fundraise was about under a year. It was about 11 months on the road. And so we're seeing this 17-month average become the new normal. In fact, about half investors say that managers now sound too much alike, and even more say that they plan to shed old relationships for new ones. So it's against this backdrop that GPs and placement agents are teaming up to raise funds. It's not easy in today's market, perhaps it never was, but GPs and agents that can set some clear goals, work in unison, and understand the LP community put themselves in good position for a successful fundraise. So that being said, let's meet the roundtable. And how about this? Mags, let's start with you, and then I'm going to ask our 4 placement agent guests to introduce themselves in alphabetical order. If you can, please give the quick background on what type of fundraisings you've done in the past in terms of strategy, size, and geography so that our audience here knows where everyone's particular skill sets lie. Mags?
Hi, good morning, everyone. My name is Mags Haladotit. I'm the Director of Investor Relations for Lateral Investment Management. We are raising a first-time $250 million fund with a private debt strategy. And previous to this, I was working for a real estate sponsor where we raised a $25 million initial seed fund and then went on to raise $125 million.
Hi there, I'm Patrick Campbell. I'm the founder and the president of Perth Advisors. We're located here in New York, and we're a registered broker-dealer here in the U.S. and an international dealer in Canada, where we mostly focus our investor attention on. I've been doing alternative funds since 1992, some hedge funds, but mostly what we do here at Perth is focus on raising private equity and private debt funds. And I've got experience in the LBO area, the real estate area. We've done distressed and sector-focused funds. And most of the constituency we focus on are institutional investors, so pension funds, insurance companies, endowments, some individuals, but it's primarily the former.
Good morning. My name is Brian Fitzgibbon. I'm the CEO of Fitzgibbon, Twigo and Company. I'm a co-founder with Sue Twigo, who is the past chairman of the Institute for Fiduciary Education and co-founder of the Twigo Foundation. I have 35 years of investment management experience, including head of marketing for a leading international firm. I'm a board member of the Third Party Marketers Association and prior board member of the Association of Investment Management Sales Executives. Fitzgibbon, Twigo & Co. has been an SEC registered broker-dealer since 2003. It's a member of FINRA, SIPC, and the MSRB. The firm is dedicated to raising assets for a few select private companies or investment managers in the alternative asset space through private placements. We're really a boutique firm which provides a marketing sales function acting on a best efforts basis to privately place funds for alternative managers, really seeking access, credibility, and funding from institutional investors, financial institutions, and family offices in North America, Europe, and Asia. Our 6 principals and representatives have attained an unusually high level of success during an average of more than 25 years each in the investment management business. We really work as an extension of the investment management organization to develop and implement marketing and sales programs directly with the management. The scope of these activities is really dependent on the client's needs and internal resources, but in all cases involves fundraising.
Hi, this is Dana Palicki from Stonington Capital Advisors. We're a boutique placement firm entering our 5th year of business. We have offices here in New York City and in Atlanta. I had started Stonington with a former colleague from Lehman Brothers after establishing Evercore Partners' private funds placement business. And we focus on sub $1 billion funds. Most are in the $200 to $500 million range. And we're increasingly working on the placement of direct deals and advise on some secondary placements as well. Currently have 2 exclusive fundraising assignments, one in middle market buyout and one in distressed credit, and a few list of names assignments on some funds. And we're also raising capital for 4 direct deals, 2 on the buyout side, 1 in venture biotech, and 1 is a value-add office building in North Carolina. Thank you.
This is Phil Koch. I'm the founder and CEO of Partner Capital Group, LLC, based in Rye Brook. We're a FINRA registered broker-dealer, placement agent, and consultant serving institutional investors, primarily in North America, U.S., and Canada. Our reach and relationships include major pension funds, foundations, endowments, family offices, funds of funds, banks, insurance companies, and institutional consultants. We specialize in alternative investments and risk management. Our founders, my co-founders, and I have over 80 years of combined experience in alternatives and with major Wall Street firms, including management and trading of alternative investment portfolios. Our transaction experience includes direct placements, fund placements, and financings in virtually all asset classes and vehicles. We do a lot with hedge funds, some private equity, hedging and derivative strategies, funds of funds, CTAs, venture capital, real estate, energy, global agriculture, financial institutions, mezz finance, and structured and specialty finance. We've completed asset raises and financings totaling over $1.2 billion. And in keeping with the firm name, we are a partnership, and we partner with others in our industry to achieve the objectives of our clients, as we have done, in fact, with Brian Fitzgibbon's firm, Fitzgibbon Twigo. And our current assignments include a lift out of a portfolio and team in the global opportunistic finance space, coming out of one of the major asset managers in the country. We're working on we represent an alternatives manager in the options space. That's the one we've done with Fitzgibbon Twigo. And we're in current discussions with a team in the infrastructure space and real estate.
Thanks, everyone. So earlier, I mentioned that we want to hit both before the papers are signed and afterwards. Let's start before the papers are signed. You have a fund manager walks into your office. They're excited about teaming up and what you can do for them. But how do they know that they will remain a priority after the papers are signed? Pat, can you lead us off here?
Yeah, sure. So listen, as Nick said, there's really kind of two components to your due diligence, on your placement agent. What happens before and what happens after, right? And at least I know on the private equity side, and private debt side, GPs are experts at doing due diligence on companies, and it's a very similar process that you should use for your placement agent, right? So you want to understand the resources of the placement agent and the number of assignments that they've got in the market. What's their experience been in terms of placing product, and is it relevant to what you're doing right now and what your plans are for the future? And then on more sort of intangibles, are they a fit for your culture? Do you get along with them? So we get some responses from GPs sometimes just in terms of our due diligence process and the intensity of it. But we view that as it's a good opportunity for both parties to really get to know each other. And it's also, we view it as a dry run for what you're going to experience on the institutional side. Because as Nick said, these offerings take about 18 months on average to get done. And I think it has become much more the industry norm, especially for emerging managers or sub-billion-dollar managers out there. And then there's other terms such as exclusivity, right? And so we think you're going to be focused on making sure that you don't have competing product in the market with the same placement agent, or to the extent that you do, those parameters are clearly defined. And the second, the last point I just want to touch on in terms of before is just key man. We ask for it on the GP side ourselves, and we're happy to give it too, to make sure that the senior executives at the placement agent are focused on your deal and giving it the amount of attention it needs to make sure that you get it to a successful completion. And then the second component is really what happens after the contract's signed, right? And so the way that we maintain a steady relationship with our clients is we have regular update calls, we have weekly calls, and there's really three components to that. One is for the placement agent to report on developments over the prior week, and what they see in the market, how many calls they've made, making sure everyone's on the same page for what meetings have been set and who's going to attend those meetings. And the second component is making sure that the GP has an opportunity to update the placement agent on what's going on in their business, and making sure that the placement agent's up to speed and that they're enthusiastic about what's going on at the GP's firm as well. And the third component is to plan ahead for what's going to be happening over the next month, over the weeks ahead in terms of the offering and coordinating travel plans, making sure you know what people's availabilities are, but making sure that the lines of communication are open at all times, because over an 18-month period, there's going to be ups and there's going to be downs. It's an emotional roller coaster, right? And so communication is going to be important for making sure that, that marketing relationship stays intact over that period. And I'll stop there.
So Pat, you mentioned something interesting about. Oh, go ahead, Brian.
Well, I think that all of those things that Patrick listed are important. I think one of the things, and I'm sure it's true with Perth Advisors as well as our firm, is that we really don't take on too many. I mean, we only take on a few select assignments at any point in time, and so the LP, the GP, always remains a priority with our firm. That because we're not focusing on 12 or 15 assignments at the same time and determining, which is most sellable and jumping on those assignments. I mean, we've made a determination clearly early in the game, as Pat mentioned, to be selective and be convinced that this assignment is doable, and it is important to our organizations from the very start.
When we talk about something being, and this is Nick here, when we talk about something being exclusive, how refined are we getting here? Are we talking about a GP should never want to team up with an agent where they're hitting the same segment of the market or they're hitting the same geographical region? And Max, if you could provide what you would feel comfortable with, is there ever an instance where you could team up with an agent and they're working on two mid-market funds as long as the strategy is different? How granular does this exclusive concept go?
Well, I mean, I think you don't want to trip over one another in the marketplace. That you can raise money from different segments of the market without bumping into one another, but you really have to divide the space so that you don't lose credibility in representing the GP in a particular segment of the market.
Yeah, I think that's exactly right. So it's Patrick here. So when we think about exclusivity, it's typically product focused, right? So we don't want to be in the market with two middle market buyout firms, right? And so that's why, like a lot of the folks here, we represent a limited number of clients, typically 2 to 4, and they're all in very different strategies that don't overlap. And in the past, I have been in the market with a product that's very similar, that really had a crossover in the fundraising period. So at one point we were in the market with a middle market mezzanine fund, corporate mezzanine fund, and we're launching a product that overlapped for 2 months with Fund 1 that was a corporate mezzanine fund as well. So the way we resolved that conflict was we were kind of getting down to the end on Fund 1 and knew where we were going to end up, and had about a dozen investors kind of still on that list that were working their way through the final process. We just excluded those dozen investors, from the investor list for the second fund, and said, well, we're going to call these later in your launch and not earlier. But I think when you're dealing with potential conflicts, the main thing, whether it's geography or product, is to get clarity. Make sure that there's clarity so there's no confusion and that all the parties know exactly what the ground rules are.
Yeah, this is Dana at Stonington. We've always found this a lot easier when the strategy is specialized, and I think sometimes areas like healthcare or credit, it's much easier to wall those off. I think lower middle market buyout is always the one that there's more conversation about, just because there are sub strategies within that. And personally, I feel a fund focused on sort of mature, let's say, manufacturing companies is a very different proposition to investors versus something that's more growth equity oriented, maybe more focused on the tech side. And but those are the ones that I think can be tougher to determine exclusivity and then to define it if you do want to go down that route.
This is Nick again. I'd imagine, are there gray areas then, if you're going to an LP, if you're going to an institutional investor, if their portfolio or their portfolio management procedures do not break along these sector-specific strategies so long as they're all lumped under mid-market buyout funds, does that create some gray areas then in terms of presenting two funds where, even though they're part of different spaces investment-wise, on the LP end, as far as the way that their portfolio is managed, they don't break it down that way. It's a mid-market fund, it's a mid-market fund. Is that a problem? Does that create gray areas?
Well, you're often going to. This is Phil Koch. You're often going to run across overlap on the LP side, where you've got one portfolio manager or specialist who's really responsible for a number of investment strategies. They don't have, except the very largest of the plan sponsors, they don't have 10 guys to do private equity. They got, one or two or three that are doing it. So there's going to be overlap.
Brian, I want to kick this over to you. How can a GP test a placement agent's understanding of the LP community?
Well, Patrick covered some of this. I think, an examination of the people at the placement firm. Are they professional? Are they a good fit with your team? Will you be able to work closely with them? Are you comfortable with them representing your firm? Would you hire them internally? I mean, these are all focused on the people at the firm. And then what is the focus experience of the placement firm itself? How long have they been in business? What strategies have they handled successfully? What are their strengths? What makes them unique? What are their target markets? What is their geographic focus? And all of these things are to determine, what type of fit that would be with your organization. The third point I'd make is, are they a licensed broker-dealer or affiliated with a broker-dealer? Are they licensed to sell securities by FINRA, by the SEC? Are they licensed by the states in which potential clients reside? Are they licensed by the MSRB to focus on public funds? Do they have a culture of compliance and commitment to stay up to date on changing regulatory environment? If they're in the licensed BD category or affiliated with a broker-dealer, it's very easy to determine if they've been convicted of fraud, bribery, or any other crime. I mean, they're more transparent as an organization. The last thing, I think, in terms of understanding your understanding of the community is really to ask for the due diligence process that the placement agent uses to examine managers. I think that would be very helpful in determining the expectation, the expertise of the organization and its understanding of the LP community. They're the points that come to mind to me. Perhaps some of the other panelists have any additional comments on this they'd like to make?
This is Dana.
Yes.
One thing I always find interesting in the interview process is, a lot of times the GPs want to get a sense of, your best relationships for their particular strategy. And this is always sort of one of those give and take points where you have to find the right balance. Where a lot of times a fund may be interviewing a number of different placement agents, and at the end of the day, things like handing over sort of lists specific to their strategy, or even in the reference process, I think there has to be some careful thought to who you're using, and because you can get sort of picked off on lists and references where they're having 5 people provide that type of information, and going at the end of the day with one or maybe none of them. And so it's something that we've always just found you have to be very thoughtful around, and you want to get across that you have great relationships, but you also have to be a little guarded until there is sort of a formal contract in place with the GP.
Mm-hmm. Yeah, it's Patrick here. I agree, Dana. Like we never go down that path for the exact reasons that you mentioned. We never want to get picked off. We're happy to provide reference lists for people, and they can see what we've done in the past and how we've done it, right? Because in my experience, a lot of times we go to market thinking one constituency will be the predominant constituency as an investor group, and we're surprised that it turns out to be something else. We go in thinking something might be an endowment-oriented product, but the public pension plans turn up, or insurance companies do, right? And the other thing we find, particularly as we're getting more and more into debt products, is you're dealing with domestic U.S. funds and offshore guys. There are a bunch of really tricky rules around that, and kind of and some structuring that you got to be aware of. And so having a working knowledge, you're never going to have a tax opinion, but having a working knowledge of what the issues are for potential investors is important to give the GP a heads up on what they're going to have to prepare for on the legal end.
This is Nick again. One thing that we've heard a couple of times now is the cultural fit. Can we dive into that? What makes a good cultural fit between the placement agent and fund advisor?
Well, maybe one thing is having the same reasonable expectations in terms of time frame, in terms of difficulty, in terms of how do I feel about this? Is there a good chemistry with this person? I think they're all part of this fit process.
Yeah, this is Phil. I would echo what Brian's saying. Chemistry is a big part of it. There's going to be good chemistry, or there's not going to be good chemistry, and I mean that when you're sort of getting into bed with each other for a year or two, a couple of years, that's so important. The cultural and chemistry fit.
This is Dane. I would just add it's interesting too, different clients we work with, even just the day-to-day mechanics of the fundraise, things like travel and that, sort of very different rules with different managers we work with in terms of, how they travel, places they stay, how much they want to travel, how much they try and minimize everything with phone calls. And, it's just also coming to an understanding on, you're going to be able to get the job done within the parameters, and that's how they want to accomplish the goals up front, I think is good for everybody.
Right.
Yeah, it's Patrick here. I concur with what everybody said, and I would just, I would just add that the courting process, for lack of a better term, that before you're signing the contract, that's really a dry run for both parties to really see if there's a fit there, and to use that time. I would all the people on the phone here are they're boutique placement agents. I think they value, the upfront work and the due diligence they do on their clients. There's another group of placement agents that it's much more of a commodity, right? It's just we'll call around for you, and you got to know what kind of relationship you want. And I think if you're going to deal with the people on the phone here, it's much more of a partnership going forward for the fundraise. And listen, it's on the low end, it's 18 months, but if it's a successful relationship for us, we've had decade-long relationships with clients, right? If it works out, it really works out well.
Great comment.
And Mags, what's the in-house perspective on this? What makes a good cultural fit from the GP side?
Yeah, actually, so just to chime in on that, I do concur with what a lot of what has been said, and I think that one of the most important things that you can do from the get-go is managing expectations. As someone touched upon, there's a lot of different styles within fund managers, and so not only do you need to assess whether there's a good culture fit, but you also need to make sure that that team works well together, because you're going to need to gel when you're going to these meetings and doing the presentations. And then, of course, another big consideration is, how new is the fund manager? How many funds have they raised previously? What is it going to take to get them going and to get the marketing efforts to a place where you're getting to not just the initial meetings, because those are easy to set up, right? Everyone can get the introductory meetings, but how do you push these meetings forward? And is this the right team that you're on the road with, and how are you going to go about it?
It's interesting because there are so many responsibilities, and hearing you list them out, everything that's involved in the fundraise, where it's scheduling meetings, when it's creating the introductions. How are all these different responsibilities best delegated? Mags, maybe we can start with you about what's best left in-house, and then where do you really turn to that third-party help for different aspects of the fundraise?
Right, and so that really comes down to what are the resources that the GP currently has at its disposal? Have they raised a fund before? Do they have materials in place? Are you starting from scratch? Are you launching a new product with a twist? And so really for the in-house capabilities, I mean, at the end of the day, it's the GP that sets the tone and messaging. It's our job to communicate that message. So we really need to work with the GP and extract from them, how do they want to position the messaging? How do they see themselves positioned in the market? Who do they see as their competitors? Because we might take a look at them and say, oh, this is another low middle market buyout shop. But if you dive into the strategy, you could find out that, no, actually their direct competitor is a lender for healthcare services, because they're focused on a niche healthcare sector. And so really to keep in-house, I think, you need to figure out, so what's the admin support that they have, and what is the marketing capabilities that they have? And then finally, with the fundraising side, how good are they at pushing people through the due diligence to close? And so with that being said, I would say at the very least, you want to have someone in-house that's completely managing all of the names and meetings that you have. So whether if you're not utilizing Navatar, which I think is a terrible idea, I use Navatar very heavily in order to manage all of the accounts. I know exactly what's going on. I know who reached out to someone last, because I can automatically record it, so it makes it very easy for me to update everything and manage the process. But at the very, very first piece, you really need to have in-house the account ownership and maintaining control of the schedule and knowing who's going where and doing what with whom.
Dana, your thoughts?
Yeah, thank you. Much of this will echo what Mags just said. We sort of look at two sides of this, and one is the capabilities of the fund's current staff, and the second is the scope of our assignment. And so first on the capability side, we see everything from no dedicated IR person in house to maybe a more junior analyst who can help with a lot of things in terms of PowerPoint presentations, but really isn't sort of leading the charge. And then also sometimes we see various seniorities of internal IR people, and so it's really sort of making that fit again of what the fund has and what they need and what they want to take on themselves. And we find that usually with respect to graphs and strategy, data gathering, and et cetera, that's often done in house by the fund, but we as placement agent view a lot of our value is really prioritizing the accounts for a particular strategy and really mapping out the roadshow calendar. And, as Mags alluded to as well, we certainly view the scheduling and working within the GP's availability is something we like to take charge of. And then secondly, on the scope of the assignment, our assignments vary quite a bit. As I mentioned in the introduction, we have two sort of full-on retainer-paying clients, and with them, we redid their materials from kind of front page to back page, and really every document they had, and we view it as we're taking responsibility for the entire fundraise, and we need to do all those things. And then we've had some smaller list of names assignments where, sometimes it's 10, 20, 50 names. And, those we'll certainly put in our 2 cents about, if we think there's something that needs to be highlighted more or something that isn't coming across right in the meeting. But it's definitely a less intensive exercise. It's not where we're spending weeks sort of turning the pitch book and creating a teaser and, working on the marketing section of the PPM, advising on data rooms and DDQs. And so I think it just depends. There is a little bit of a lot of times sort of, you get what you pay for, and it's really figuring out what the GP's need to fill is and making sure that that's the proper fit with the agent and everyone's on the same page.
Dana, you mentioned a few interesting things there. Nick, again, there's some variance in who you're communicating with at the GP level, that at times it's a junior analyst, at other times it's more senior. What works best? And Max, if you could jump in as well, too. You are someone of a senior level. Would you ever delegate some of the communication touch points with the placement agents to someone junior beneath you?
Yeah, just to kick it off, so just thinking of our 2 assignments right now, the one fund, it's a $175 million buyout fund, does not have a dedicated person in-house, so the hands-on day-to-day is very much, with the senior people, and they rely on us, to a very high degree in terms of all aspects of the fundraise, and I think, that can work. It's just it's a different relationship where they're really looking to us to provide the map, execute, and get the fundraise done. Certainly, the other assignment, actually, there's in-house marketer there. And, there it's a mix of, dealing with the marketer in that case. But a lot of times our accounts are sort of outside of some of the things that, she happens to be doing in that case. And on those, sometimes we'll deal directly with the investment team and just in coordinating them to come out to meetings and advising on, the presentation and the meeting itself.
Yeah, this is Max. I mean, I think that honestly, I do not make it a habit of delegating anything communication-wise to a junior member. For me, I utilize that more as a resource to get all of my reports updated and make sure all of the I's and T's are crossed when it comes to roadshow, calendar planning, and that type of scheduling. At the end of the day, I would say most of the placement agents, when I first started, on 2 separate engagements, they would go to the GP first, and then by the end of the month, they would go directly to me because I have my hands in everything or know what's going on, and I'm going to give them an answer much faster than they are. And it is, unfortunately, you also have to consider, GPs, well, our only position and our only focus is to get this fund raised. They have a million other things they need to focus on. So anything that we can do to make their lives easier is also critical, I think, to having a successful raise and finding a good fit.
Interesting.
Well, speaking of good fit, are there any examples of when it's not been a good fit? Are there any anecdotes or stories about where the relationship could have been better? Phil, do you mind if I target you for this question?
No, happy to chime in on this. I very recently, just in the last year or so, had what turned out to be not a great experience where it simply didn't turn out to be a good fit. We had been introduced by an industry veteran to a firm that had a specialized strategy in the options and derivative space, which is an area that we have quite a bit of experience and capability in. We spent a fair amount of time getting to know the general partner and the team, and finally did agree to take on the assignment. But one of the things, and not long after we got started, one of the things that we had really not scoped out well in advance was their commitment, really their financial commitment to the raise, and to they wanted to maintain control over all the marketing material, including the teasers and the performance updates and the presentation itself. And it turned out that once we started reviewing and commenting on the presentation that they had and the work that needed to be done, they simply didn't want to do it or didn't want to spend the money to do it. And there were some real problems there, and we have enough experience in the space that we knew what was needed and what needed to be taken out, what needed to be added, and what needed to be massaged, and so forth. And they were almost obstinate about it. And not only that, but the GP turned out to have a rather lofty view of himself, and didn't want to really get too involved in sales calls and meetings and presentations and so on. So they wanted the traders to do it all, and it just went from bad to worse. And we agreed to disagree and go our separate ways before we got too far into the whole process. But it was. And they'd paid us a small retainer up front, so they had a little bit of skin in the game, but as it turned out, not enough. And it was one of those unfortunate experiences that I suppose we all have at one point or another in our careers, and this one came a little later than I was expecting. But that's kind of the way it went, and we moved on.
Does anyone else want to jump in? I know it's a difficult question.
So
yeah, this is Dana.
Lesson learned, I guess, was managing expectations. We didn't do a good enough job of understanding what their expectations were of us and what our expectations were of them, particularly in the things that they wanted to control.
This is Dana. I was just going to add that one area that we found to be a common thread is we have found it easier to work, with funds when there is some people with at least some experience with a fundraising, earlier in their careers, even if it's a new firm, at least they were involved in it in some way at a prior firm. And one of the tougher ones we had was it was a spin out, and they had sort of unrealistic expectations about we're going to hit the market and this thing's going to get raised in 6 months because there's always, some fund out there GPs will point to, oh, well, this thing got raised in, 4 months, 5 months, and this is, the 1 or 2 funds a year out of the 2,000 funds in market where this happens. And, I think people, it is education and a process. And again, this gets back to setting the expectations and knowing you have buy-in from that GP on what it takes to get a fundraising assignment done. Is just critical because it is in most cases a long journey. And even when you look at that 17-month, average that Nick mentioned earlier, that includes some of these, funds that GPs are, LPs are fighting to get into. And because they've had so many successful funds, the team stayed together, and those can get done very quickly. So I think when you're looking at more of a regular wave fund, I think that number is just a lot higher than 17. And I think if you looked at a median, it would be definitely in that 24 type of number.
Well, sure, because it's probably these statistics are dollar, weighted probably, and these big fundraisers, on a 5th or 6th or 7th time fund are easier raises, and our collective problem is that these quick raises are the ones that really are headlined in all of the financial publications, and of course everyone in the industry reads it, and so there is this expectation that it's easy and can be quickly accomplished.
Yes, Phil, I agree 100%.
Well, Nick, again, this raises an interesting question. So you have a GP prospective client come to meet you. They want to assess your track record, your performance, and let's say that they've read in the financial trade publications about all these lightning quick fundraisers. They want something similar. They want to see what you've done. The way I understand it is that this is like comparing apples to oranges. Pat, maybe you can describe to us, is there a way that GPs can fairly and accurately assess a placement agent's track record?
Sure. I think we've touched on a number of points here that are valuable, but it all comes. The simple metric is how much capital have they raised in the past, and where have they been successful. And I think all that has to be viewed in the context of whatever was going on in the market at that particular time, right? So I think when you're doing your reference check on the placement agent, I would focus on these 3 points just to give you some sort of data points as to how it would relate to you, in a given market. So we go to sponsor is point 1, product is point 2, and market conditions is point 3, right? So sponsor, you're really getting at how well known is the sponsor in the market, which for us is the institutional market. Is it a well-known name or not? And second is the product. Now, many times the sponsor just has one product. It's a middle market buyout fund, so they just have an equity middle market buyout fund. But in a number of instances for us, a lot of times we do either repositions or we'll do new products for sponsors, right? So what is it the right product for that particular market? And third, what are the actual market conditions that you're marketing in? Is it a hot market? Is it a cold market? And so I'll just give a couple of quick examples here. We have a client right now. They came to us in 2011 with $30 million under management. As a real estate opportunity fund sponsor, 2 very, very good investors, but not well known in the institutional community. So 2011 in the real estate market, and they had an opportunity fund that did both debt and equity. A lot of opportunities or funds around in 2011, 12, 13, and a market that was really recovering. So 2009 particularly brutal, especially for real estate. 10 trying to find if the market's got any feet, and then 11, 12, 13, those that's a market that was really kind of coming back from the devastation of 2007 and 8, and we between the middle of 2011 and the end of last year, we raised a little over $450 million for them in a couple of funds and a couple of separate accounts as well. So that first $100 million, or $1 in October of 2011 was a lot harder than our last $100 million. The last $100 million was the back end of last year. The first $100 million took us 20 months. The last $100 million took us less than 3 months, right? And so, I think you just need to assess, where that fund was and what was going on in the market and where the sponsor and the product was in that particular market cycle. And then just, another quick example, we had a middle market, my prior firm, we had a middle market buyout fund in 2000 with a very well-known sponsor, but a product which was the most boring middle market buyout fund you could possibly imagine in the height of the internet boom, and then the subsequent crash. And so you had a very, you're basically counterselling, you're mildly contrarian bet in that market, which was very tech focused, and you were going to be very tech and momentum investing versus a very value investor approach. So you're counterselling in a market like that, right? And we were able to sell through the tech part, and then we actually had the final close for that fund the Friday after 9/11, and we we're able to hold, the preponderance of that capital together, for that final close during a very tumultuous time. So the short answer, coming back to it, is just it's not just the money, it's the context of what's going on in the market and what the placement agent was able to help the sponsor do.
This is Dana. Go ahead.
I was just going to ask Mags what the in-house perspective on that was. When you're reviewing placement agents, how much weight you give to vintage year, how much weight you give to sector? Are there other variables that have not been mentioned?
No, actually, I thought that was pretty comprehensive. And again, it just really comes down to the fundraising environment. So about a year and a half ago, I thought that the fundraising environment was quite good for credit and equity products, and that changed very dramatically and quickly as of last August when there was a huge drop in the market. It just really depends on where we're at. I think the most thing is really figuring out where we are at in the market, what the investor's appetite. This also goes back to where, we have to remember, so as fundraisers, this is our most important and biggest priority. For fund managers, they think that their product is the best and obviously the most solid risk-return profile or whatever it is that the investor is looking for. But we have to remember what it is that the investor is seeking at the time. And I think, we have to really be extremely responsive and sometimes very creative to figure out how to get in front of the right people, even sometimes when the timing isn't the best timing for the market.
Dana, did you want to jump in?
I was going to add from a evaluation perspective, one thing we had a manager ask us of recently that I thought was pretty thoughtful was, everyone kind of does case studies and, you highlight your most successful stories. They had specifically asked about the challenge in each fundraise and what we had done to address it. And, the reality is I think most funds out there generally, and then probably even more so ones hiring placement agents, often there is some challenge, and whether it's a team member leaving or a more senior team member transitioning out, maybe dropping part of the strategy that was the less than successful part of their overall strategy. And sometimes, can even be transitioning from, more of a mix of credit and equity to more equity, or even just doing a larger fund. And I just thought by asking that question and really trying to flush those issues out on our fundraisers and how we had successfully marketed through them was a good exercise for everybody.
Right.
So being conscious of time here, I want to kick it over to audience questions. We have the first one coming in, Sarah from New York, asking about price and cost models, how they're negotiated today. If I were to paraphrase her question, and this is touching back on something that I had mentioned during the start of the webinar, if there's a power pendulum favoring one party over another, Dana, do you want to grab this one too?
Sure, and I think it is still very fundraise specific. I think the kind of two things that have really been the biggest changes in the market is, first of all, the evolution of the retainer model. And I think since 2008, when fundraising got harder, there's more competition, there's more funds out there, LPs are more highly selective, and just taking longer. The retainer model really started to develop, and before 2008, you didn't hear too much about it. Now for kind of full fundraising assignments, it's pretty standard. Some of it's monthly, some of it's upfront. And then there's also, obviously a whole package of other fees to be negotiated. And while 2% on capital raised has kind of been the industry standard, there's also often fees for, both the GPs re-ups, which, can range from nothing historically to sometimes there's more of an administrative type fee on those of, let's say, a 15 to 50 basis points. And then there's also continuation right discussions for the next fund, more generally, and also with respect to specific investors, the placement agent brought in for Fund 2, what would happen if they come into Fund 3. And I think increasingly sort of a 50% fee for those types of investors coming back is, also in order. And I think, Nick, specifically on the re-up question, this one can be a tough one for both sides because I think it's very easy for sort of the GP to say, well, those are our investors, we know them well. But then a lot of times the key people have changed at those investors, and some GPs do a better job than others at keeping up with those changes and getting to know the new guard there. And sometimes also the investor may be the same, but their relationship may have been with someone different at the firm, or maybe there was a more senior member of the firm who's now transitioning out, and maybe the next generation of partners at the firm don't have as strong of a relationship. I think in those cases, it can also make sense to incentivize the placement agent to, help work those relationships as hard as, because we've certainly had re-ups that we've put every bit as much time into a new investor. So a long story way of saying, I think, again, it's just the total package and making sure that, the GP is getting what they need out of that, and the placement agent feels that they're incented to, make the whole fundraise work.
Does anyone else want to speak to that?
No, I agree with it.
Yeah, it's Patrick here. Listen, I think, Dana really did a great job of summarizing that. There's really, in most relationships, there's kind of three main toggles, right? There's the retainer, the cash success fee, and then in some cases carried interest, right? And I think, we try and be conscious of, especially for our emerging manager clients, we need cash to run our business. They need cash to run their business. And so we're cognizant of that dynamic, and frankly, it's part of our upfront analysis to make sure that they can pay themselves and pay us, like two very important things for the success that's achieved. Because I think you really kind of got to get yourself on the private side, 250 to 300. You need to get there as soon as possible to really make any money in this business on the GP side, and sometimes that takes a couple of funds to get you there. And so we're cognizant of their cost, the costs associated with their business, as well as, what we need to be paid for our success here as well.
We have time for one last audience question. This is coming from Gerald in Philadelphia, and I'm paraphrasing here. The types of rules or regulations that need to be discussed before those papers are signed. Phil, do you want to grab this one?
Yeah, I'll take a stab at it. I think this boils down to a lot of what Brian touched on earlier in terms of FINRA registrations, being with a broker dealer, having your own BD, or being affiliated with a BD, and knowing where the placement agent is going to be targeting, whether they're registered in those areas, yeah, I don't really have much more to say on it than that.
Well, that just about does it on time. As mentioned earlier, a recording of the webinar is going to be sent out to all attendees, so look out for that in your inbox. I want to thank our roundtable here for what proved to be a fun and informative conversation. On behalf of Navatar Group, I'm Nicholas Donato, and please do make sure to enjoy today's warm weather. Thanks, everyone.